So you won the house? Great! Now, let's get you to the closing table. This video is the second in a series of videos that are made to give you the information that you need to know about the closing process so you can feel confident when you get there. Today, we are going to go through some of that jargon, that lingo that you are probably going to hear when you're at that closing table. I'm Caroline Reed with The Real Deal, the place to go to get the confidence and the clarity that you need to make the right real estate decisions for you. And today, we are going to talk about closing lingo. And it's important to know that not every term means the same in every part of the country, but we're going to go over some general terms. And this is not all of them by any stretch of the imagination, but these are ones that you are most likely to encounter. The first one is an abstract. An abstract is just basically a collection of all of the documents that kind of chronicle the history of that piece of property. All of the deeds, every time the deed changed hands. It could include things like wills or tax issues or probate problems, but anything that chronicles the history of that piece of property. And if you buy an old house, that could be like inches thick of all of the times that piece of property has changed hands. But not all counties keep every piece of document. Sometimes they just kind of change the top page every time. That's called a torrens, and some of it is online. In any case, your title company will help you. The next one is amortization, and that actually comes from Old French, Old Latin, mort, meaning to die. And essentially it is killing off a debt by paying it off bit by bit. Next to that is amortization schedule. Now this you are likely to see when you close on your mortgage. The amortization schedule is just that. It is a schedule that shows you every payment that you are scheduled to make. It keeps track of the balances of your the principal that you've paid down, the interest that you owe for every payment that you are to make on that loan. The next one is an annual percentage rate. Now you probably heard about an interest rate from your lender, and hopefully you have heard about the annual percentage rate from your lender as well, but maybe not. So just in case, it is important to know that the annual percentage rate is the interest rate plus all of the fees that the bank puts in there to service the loan. That comes up with a different number. That different number is the annual percentage rate, which is actually the true interest rate for the loan. Next is appraisal. The appraisal is somebody's opinion of the value of the house. The bank usually hires somebody to go take a look at the house to make sure that it is worth the amount of money that you want to borrow. And the important thing to note about the appraisal number is that if that number does not come out as high as the amount that you are promising to pay for that house, you're going to have to come up with that difference in cash at the closing table. Next is a closing disclosure. Now, this is a document that needs to go to you as the buyer at least 3 days before closing so you have a chance to look at it. And basically what it is just a sheet of paper that shows you all of the costs that are associated with the closing. Next, we have the closing statement, which is a little bit different than this closing disclosure. The closing statement you are going to see at the closing table. And it's basically just a ledger of both the buyer and the seller and all of their debits and credits for each one of those. So you can have a chance to look at those, make sure that they're correct, and know who is paying for what. The next is escrow. Basically, escrow is when you give to a neutral third party, like your title person or your closer, any of the documents or monies associated with this real estate transaction. And that person is then given the responsibility of dispersing all monies and distributing all the paperwork to the rightful parties when all of the conditions of the closing have been met. Next is joint tenants. That's when 2 or more people hold the property jointly, like a husband and a wife. Then if one of those people should die, that person's share in the property gets transferred to the surviving person. So if the husband dies, the wife gets the house. This is different than tenants in common. tenants in common is when you have two or more parties holding the rights to a property. But when one party dies, their equity share in that property passes to their heirs, which is not necessarily the other person who holds the property. It could be that that party still has a will naming their children as their heir, in which case the surviving spouse would own it jointly with the surviving heir children. Next is a lien. And a lien can have two definitions. One is when you use the property as collateral on, let's say, your mortgage loan. Your mortgage company will have a lien against the property. But it also can be used as a matter of law. So if somebody has performed some work on the property and they haven't gotten paid, they can get a judgment lien against the house so that if the house is sold, part of those proceeds will go to pay that debt. Next, owner's title policy. An owner's title policy is an insurance policy that you as the buyer buy for a one-time fee that protects you against defects in the title of the house. Now, the lender is going to go and get their own policy, but you have the choice whether you want to get an insurance policy for yourself. And that title policy protects you just in case the title company makes a mistake when they're searching through the records, just in case somebody has forged their name on the deed, or just in case there's an heir out there from a previous owner that nobody knew about and is now coming forth to stake their claim in your property. Next is the note. The note is usually known as either the promissory note or the mortgage note. But in essence, it is a promise to another party to pay a specific amount of money over a specified period of time. Next is the settlement, or some places call it the closing. This is where you've been trying to get all along. It is the final piece where all of the funds are dispersed, all of the documents are sent out where they're supposed to go. Think of it as all of this rigmarole that you've been doing to get to the closing table. This is where the dust will settle. The title search. This is where the title company goes out and searches all of the public records looking for information that has anything to do with that particular piece of property that you want to buy. They make sure that the person selling it indeed has the right to sell it and that nobody else out there has a right to that property. And the one that I have saved for last could win you a trivia game. It is mortgage. Now, everybody thinks they know what a mortgage is, right? That's a loan that you get from a bank, but that would be wrong. A mortgage is actually the promise that you give to the bank that you will pay back the loan. So you actually don't get a mortgage. You actually give a mortgage. It is a pledge to a creditor using the house, the land as collateral that you will repay your debt. But good luck proving that because all of the references online reference it as getting a mortgage and not giving a mortgage. But they're wrong. And like I said at the beginning, this video is the second in a series of videos on the closing process. So if you want to see the first video in the series, you can go ahead and click right up here. Thanks for watching. See you next time.